Hey everyone, welcome back to Corporate Decoder. Today we're diving into ConnectOne Bancorp's latest 10K filing, and trust me, after looking at this you'll understand more about the company than their shareholders. Just kidding. Mostly. So what's the big picture? ConnectOne Bancorp is a bank holding company, and this report covers their business, how they're doing financially, and what could go wrong. Think of it as a financial health check with a side of potential problems. First, a little warning, this report contains forward-looking statements. Basically, ConnectOne is making predictions about the future, and there's no guarantee they'll come true. Things like competition, interest rates, and even health emergencies can mess with their plans. Let's talk about ConnectOne's growth. They've been busy merging with other banks, most recently the First of Long Island Corporation. If regulators give the okay, this merger should be completed soon. The company has also acquired BoeFly, a marketplace for small business loans. ConnectOne operates mainly through its bank subsidiary, ConnectOne Bank. They focus on small and mid-sized businesses in the New York metro area and also have presence in South Florida. BoeFly is the fintech marketplace that connects franchise borrowers with funding. Now let's check in on those financial results. Most of their income comes from the difference between what they earn on loans and what they pay out on deposits. They offer checking accounts, savings accounts, loans, and other banking services. Like any bank, ConnectOne faces a lot of competition. They compete with other banks, credit unions, and even online lenders. To stand out, they focus on providing personal service and quick decisions. ConnectOne recognizes that their employees are important. They're investing in training programs and offering benefits to attract and keep good people. They promote from within, so their employees have lots of opportunity. Being a bank holding company means following a ton of rules. The Federal Reserve, the FDIC, and other agencies keep a close eye on them. The Dodd-Frank Act, passed in 2010, increased regulation. There are also capital requirements that they must always meet. Time for a look at the risk factors. What could hurt ConnectOne's business? Real estate loans are a big part of their portfolio. It could be a big risk if those borrowers can't repay their loans. This is why, as a preventative measure, they are putting all efforts into cybersecurity. Now let's talk numbers, the core of any financial analysis. For the year, net income was $67.8 million. Sounds like a lot, right? But it was down from last year. What contributed to the decrease in net income? Well, net interest income dropped. Non-interest expenses rose, driven by spending on technology and increased salaries. The provision for credit losses also increased, and what that means is that they set aside more money just in case people start defaulting. The other side of the picture, ConnectOne's total assets were $9.9 billion, slightly higher than the previous year. Deposits increased, but loans decreased a bit. A big component of the assets are commercial real estate loans, which represents over 75% of loans receivable. The FDIC, which insures deposits, also makes them pay special assessment to recover loss from Silicon Valley Bank and Signature Bank. ConnectOne operates a number of banking offices in New Jersey and New York, with one office in West Palm Beach, Florida. Their headquarters is in Inglewood Cliffs, New Jersey. ConnectOne has policies and procedures designed to protect against all these risk factors. One of the biggest risks right now is cybersecurity. The company uses a mix of internal staff and outside experts to protect against cyber attacks. Let's look at what could impact the company's structure. Anti-takeover provisions might make it difficult to remove current management, even if shareholders aren't happy. This can give management more job security, but it can also make it harder for investors to hold them accountable. Banks with over $10 billion are subject to requirements. The company may be required to invest more significant management attention and resources to evaluate and continue to make any changes necessary to comply with the new statutory and regulatory requirements under the Dodd-Frank Act. Also, with the upcoming merger, there is uncertainty regarding the effect of the merger on employees and customers. This could harm ConnectOne's ability to attract, retain, and motivate key personnel. Let's move on to general banking industry risks, like their allowance for credit losses. It might not be enough to cover actual losses if there are high defaults and non-performance. And increases in interest rates could harm borrowers' abilities to repay their loans. Federal and state laws and regulations affect the banking industry and ConnectOne, and changes can increase the cost of doing business or otherwise adversely affect us. So what's my take on ConnectOne? They've shown a strong focus on growth through mergers and acquisitions. While the merger with First of Long Island presents opportunities, there are risks such as integration and regulatory hurdles. The decline in net income and the increase in non-interest expenses are areas to watch. I think the company is well managed. I will definitely keep this on my watch list. Now it's over to you guys. Don't forget to subscribe, like, and comment for more corporate decoder videos.